Hello, everyone. Thanks for joining us today. We're going to go over our second quarter market review from 2021. This happened between April 1st and June 30th. Market review. As we can see here on the left-hand side, stocks, equities, based off the S&P 500, were up 8.5%. And international emerging markets, US bonds, international bonds, as well as emerging market bonds were positive for the quarter as well. So it was nice to see. Last year in 2020 was a different story. We saw technology, it was up over 32% for the year. No surprise, we were all on Zoom, our phones, our laptops, watching television. This year, it's real estate. They're pushing up double-digit numbers as well. And right here in the Bay Area, we can see homes that are listed for $1 million. They're being bid above 10, 20, even 30% over, sometimes higher, over asking price. So it's a good time to be a seller. Bonds, on the other hand, here you can see year to date, they're still down, negative for the year. Not a major concern. Bonds are still needed for that ballast in the diverse portfolio. Still important to have. What's leading the growth? There's a couple indicators. Number one is the Federal Reserve is keeping interest rates low. They're keeping it right around 2%, and they're going to hold this rate until about 2023 is what the news came out from the Reserve meeting. And it's a nice thing. So keep it around 2%. We're able to buy homes, get mortgages at 2-3% interest rates. We're able to buy new cars if we need new cars. And for big corporate businesses, they're able to borrow money and expand, at low interest rates, as well as small mom and pops businesses as well. Second indicator we can see right here is job reports, or unemployment, I'm sorry. Unemployment is in single digits. It's down about 6.1%. Not a big concern. What's different though is there's an equal number of job openings. So we're seeing that right now. And the pandemic, which we're still in, it's changed businesses permanently. We're seeing a lot more hospitality and retail companies shut the door. And we're seeing online companies that are outsourcing overseas or out of state. And what's happening to the wage rate is we're seeing the wage rate drop down because of competition. Okay, where are we in the recovery? As we can see here with the little arrow, we're in expansion. We're in the green here. It's still early cycle, but the economy and stock market are beginning to be in a normal pace, which is nice to see. And the outlook right now is bullish. So we're getting a green light to invest. This is neat. Back in, after the Depression in 1929, over 91 years ago, there was a bear market of 83%. We just went through a world war, and economy was ready to vamp back up. Bottomed in 1932, the market. It only took 3 months to double. So this was the fastest recovery in history to double so far. Last year in March 2020, as we can see, market dropped almost all the way down to 34%. It took 15 months to double, so it was pretty quick. And we just witnessed the second fastest recovery to double in history. It was painful March 2020, but now it seems a little bit better. Some headline news: inflation. What's driving a lot of this impact? We can see here on the yellow line, this is consumer spending. In the US, 70% of the economy is driven by people going out to restaurants, buying new cars, buying houses, getting mortgage loans, traveling. That stopped. It went off a cliff here, March 2020. People were at home, staying home, not spending money. And what that did was, here on the red line, it drove up consumer savings into their checking accounts, into their money markets accounts. This allowed for a lot of money to be saved so you can, purchase new homes or, start to travel now as well, which is nice. And what happened, it caused a big bubble in used cars. So used cars account for 27% of this inflation demand. And another 25% was because of new cars. Factories, they pretty much halted on production, and now they're starting to pick up the gas and get new cars out there, as well as new car parts. And just to let you know, inflation is normal, a little bit's okay. Right now we're in a good spot. Things are going to start to normalize here in the next couple months, but we're going to be okay. Another headline news is long-term capital gains. We know this is down the pipeline here. The last 50 years, since the 1970, long-term capital gains have been hiked up 3 times. And what's happened the next 3 months preceding that is, the stock market reacted in a positive way. We all like to pay less taxes, but it's not a bad thing. Taxes go towards infrastructure, building bridges, building roads, building highways. It's good to see this for ourselves as well as our families. So paying the extra capital gain tax, it's going to be okay. Some key takeaways: markets, investments, and economy, they continue to grow. And it's important to stay disciplined, and focus on your long-term goals the next 5, 10, 15, 20 years down the road. Maintain that risk and preserve the capital. Us as advisors, our job is to hit you those singles, those doubles, not a home run and not to strike out. So we have a long journey, and we're not here to make you rich, we're here to keep you rich. So we still have a long journey ahead, and right now the economy and markets are looking very positive. I wanted to thank you all for joining us today. Look forward to seeing everyone soon. Thank you.